Want to add a high-quality Dividend Aristocrat to your portfolio? Looking for a market-beating yield paired with double-digit dividend growth? Like the idea of buying shares on sale after a 30% plus drop in pricing? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before we get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for our special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a leading medical devices provider. What do we know about humans? Well, there's ever more of us walking around. The global population recently hit 8 billion people. That's nearly double the global population compared to when I was born only 40 years ago. What else do we know about humans? Our bodies slowly deteriorate as we age, resulting in the need for quality healthcare. Increasing humans, increasing healthcare demand, increasing revenue, increasing profit, increasing dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Medtronic PLC, which appear to be trading at a significant discount today. Medtronic PLC, stock ticker MDT, is a global developer and manufacturer of medical devices for chronic diseases. Founded in 1949, Medtronic is now a $106 billion by market cap healthcare titan that employs 95,000 people. The company reports results across 4 segments: cardiovascular, 36% of fiscal year 2022 revenue, medical surgical, 29%, neuroscience, 28%, and diabetes, 7%. Medtronic's product portfolio is comprised of a variety of life-saving and life-improving medical devices that include implantable defibrillators, heart valves, insulin pumps, glucose monitoring systems, pacemakers, stents, and surgical tools. Healthcare in general enjoys secular growth. Healthcare demand does not correlate with economic cycles. If one is in need of care, it doesn't matter whether or not the economy is in a recession. The health issue is all that matters to that person at that point and must be rectified. The human condition essentially builds in a constant base level of demand for care as human bodies slowly deteriorate during the aging process. On top of that, our global population is growing. The world's population recently hit 8 billion people for the first time. Simultaneously, people are, on average, living longer than ever before. Also, the wealth of the average person continues to rise. This results in more older and wealthier human beings walking around, and you can almost draw a straight line from that demographic shift to increased demand for quality healthcare. That's the general state of healthcare, but Medtronic specifically is situated very favorably. This is due to the inelastic demand for its products. The spending on these products is usually non-discretionary in nature, especially if it's a life or death situation. In that kind of situation, pricing is a non-concern. Let's say, for example, you need emergency surgery. Pricing of medical devices not likely to be a high priority for you in the moment when you're more concerned about not dying. This means Medtronic benefits from constant demand, rising demand, and inelastic demand. That's a powerful triad. If that wasn't already good enough, Medtronic has also built up advantageous leadership in the areas in which it competes. Morningstar puts it like this, and I quote, "Medtronic has historically held roughly 50% share in its core heart devices. It's also the market leader in spinal products, insulin pumps, and neuromodulators for chronic pain," unquote. As you can see, Medtronic almost can't lose over the long run. That's why it's set up so well for continued growth across its revenue, profit, and dividend for years and years to come. To date, the company has increased its dividend for 45 consecutive years. That's one of the longest dividend growth track records in all of healthcare, easily qualifying Medtronic for its status as a respected dividend aristocrat. The 10-year dividend growth rate is 10.3%. To go along with that strong rate of double-digit dividend growth, the stock currently yields a market-beating 3.5%. This yield is 130 basis points higher than its own 5-year average, which is a remarkable spread. And with the payout ratio at 51.6% based on midpoint guidance for this fiscal year's adjusted earnings per share, this is a healthy dividend poised for more growth. I favor dividend growth stocks in what I call the sweet spot, a yield of between 2.5% and 3.5% paired with a high single-digit or higher dividend growth rate. This stock is at the higher ends of both yield and dividend growth, making it very, very sweet. Looking at business growth, Medtronic moved its revenue from $16.6 billion in fiscal year 2013 to $31.7 billion in fiscal year 2022. That's a compound annual growth rate of 7.5%. Nice. I usually look for a mid-single-digit top-line growth rate from a mature business like this. Medtronic easily exceeded my expectations. However, a large chunk of this revenue growth was as a result of the acquisition of Covidien plc in 2015 for almost $50 billion. This complementary addition to the company, with Covidien focusing on endomechanical instruments, adding to Medtronic's cardiovascular and orthopedic offerings, gave a large boost to the top line in absolute terms. Looking at relative growth on a per share basis should give us a better idea as to what's really happening here. Earnings per share grew from $3.37 to $5.55 adjusted over this period, which is a compound annual growth rate of 5.7%. To be fair, I did use adjusted EPS for fiscal year 2022, and that's because of certain issues that impact GAAP earnings per share and make comparisons difficult. The bottom line growth here isn't bad, but I think it could have and should have been better if not for two serious headwinds, one of which is not the company's fault. First, Medtronic's outstanding share count has been increased significantly as a result of the company using equity to help finance the Covidien acquisition. This has made growth on a per share basis more difficult. Second, the pandemic has greatly affected Medtronic. The global focus on the pandemic meant that anything that could be delayed, such as elective surgeries, have been delayed. Making matters worse, key product launches coincided with the pandemic, and it's been hard to bring supply to the market. What this means is that Medtronic has been facing both supply and demand challenges over the last 3 years. There is a flip side to this though. Surgeries that could not be performed previously are almost certainly demand deferral, not demand destruction. Delayed healthcare is likely causing pent-up demand, which could prove to be a strong growth driver for the business over the next few years. And the addition of new products to the market precisely at the same time as rising demand could be a potent mix for the business, turning a former headwind into a new tailwind. Looking forward, CFRA is projecting that Medtronic will compound its earnings per share at an annual rate of 8% over the next 3 years. Notably, this forecast was at 7% as recently as this summer, so we've had a decent bump here. CFRA reinforces what I just stated, and I quote, "We see potential for strong appreciation in Medtronic shares over the next year, driven by its broad lineup of new products and high exposure to recovering global medical procedure volumes," unquote. Delving into the new products, CFRA adds the following, again, and I quote, "Key Medtronic products to pay attention to, both launched and soon to be launched, include Micra AV pacemaker, the renal denervation program, and the Hugo robotic-assisted surgery platform," unquote. That last product is especially exciting as robotic-assisted surgery platforms are likely going to be big growth drivers over the long run. CFRA agrees, again, and I quote, "One product line that has particularly immense potential is Medtronic's robotic-assisted surgery platform, which we see ultimately being adopted worldwide, up from just 8 countries using the technology in fiscal year 2022, unquote." With all this said, I think Medtronic is compelling for dividend growth investors over both the short term and the long term. Pent-up demand could cause a substantial near-term bounce in business, and the long term is bright because of the structural nature of global demographics and global healthcare. Medtronic's business is already situated to benefit from this structural nature, but new products only serve to strengthen the company's competitive position. If we take CFRA's earnings per share growth prediction as the base case, that should set up the dividend to grow at least at a similar rate over the foreseeable future. Pairing that with the 3.5% starting yield gives investors an extremely appealing combination of yield and growth. Moving over to the balance sheet, Medtronic has a rock-solid financial position. The long-term debt-to-equity ratio is 0.4, while the interest coverage ratio is 11. Profitability is already fairly robust, but I think the coming years will show even better numbers. Over the last 5 years, the firm's average annual net margin of 13.6% and annual return on equity of 8.1%. To give perspective on what could be coming down the road, net margin came in at nearly 16% for fiscal year 2022. Medtronic is a great business that should become greater as supply and demand shocks abate. And the company does have durable competitive advantages that include IP, R&D, switching costs, economies of scale, a global distribution network, high barriers to entry, and a diversified portfolio of entrenched products. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. I see all three of these risks as being elevated compared to other business models. Any changes in the way healthcare spending is managed, especially in the USA, would almost certainly impact the company. Medtronic occasionally recalls products, which involves cost and reputation risks. Demand for medical devices is fairly disconnected from economic cycles, but a recession could cause people to delay or cancel elective surgeries. Any major technological changes in medical devices can alter the competitive landscape, which pressures Medtronic to constantly innovate and stay ahead of the tech curve. No business is without risks, and Medtronic is no different here, but I still think this business looks captivating for long-term investment. And with the stock down more than 30% from its 52-week high, the valuation makes it especially captivating right now. The forward PE ratio is only 14.6 based on midpoint adjusted earnings per share guidance for this fiscal year. That's a very low earnings multiple for a dividend aristocrat of this caliber. The price to cash flow ratio of 16.4 is also favorably detached from its own 5-year average of 21.4. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. This dividend growth rate is below the demonstrated long-term dividend growth rate from the business, and it's also quite a bit lower than the expectation for near-term EPS growth. On the other hand, EPS growth over the last decade does trail this mark. I'm assuming a rebound in this highly resilient business, and it wouldn't take much for Medtronic to make good on this, unless Medtronic is permanently impaired from what's transpired over just the last 3 years. This kind of dividend growth rate shouldn't be overly difficult to match or exceed. The dividend discount model analysis gives me a fair value of $116.96. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. Dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Medtronic as a 5-star stock with a fair value estimate of $112. CFRE rates Medtronic as a 4-star buy with a 12-month target price of $104. I came out very close to where Morningstar is at on this one, but we all see severe undervaluation here. Averaging the three numbers out gives us a final valuation of $110.99, which would indicate the stock is possibly 44% undervalued. Here's the bottom line, guys. Medtronic PLC is a high-quality business that should explosively rebound higher as supply and demand shocks fade. Demographic trends are on its side, and new products are coming out at just the right time. With a market-beating yield, a double-digit long-term dividend growth rate, a balanced payout ratio, more than 40 consecutive years of dividend increases, and the potential that shares are 44% undervalued, this dividend aristocrat is screaming for long-term dividend growth investors to consider buying it. And now for a special news announcement. Microsoft Corp, stock ticker MSFT, just got announced as one of the winners in cloud computing contracts from the US Department of Defense that could hit $9 billion through 2028. This is a multi-billion-dollar slice of totally new business for the tech giant. Microsoft just keeps getting bigger and better. We've covered this name multiple times on the channel already, but I must say once again that this is one of the best long-term investment ideas for dividend growth investors. Don't sleep on Microsoft. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.